Okay, Assalamu alaikum. Good afternoon, everybody. Before we will kickstart our meeting, I just want to give a little bit overview about IPIP. I just want to share a small video we have.
IPIP, Irish Pakistani ICT Professionals. An open access platform for present and future Irish Pakistani ICT professionals. Professional and social networking. Information and training seminars. Career guidance events. Upskilling sessions. Community get-togethers. Irish Pakistani ICT professionals. Join us, guide us, contribute and play your role in this community building project. IPIP, Irish Pakistani ICT professionals.
Good afternoon. Before we will kickstart, I would like to give you a little bit background about IPIP. We have started this small association in 2019, early 2019, and where we were just main objective is just to empower all ICT professionals living in Ireland to get the jobs in ICT sector, to get the trainings, to just start the business or just manage their monies. So previously we had another webinar about financial sector. So today we have Peter. Peter has been helping businesses and individuals from the last 30 years to just build the financial strategies. So before I will just give this one podium to Peter, I will say that this is the main. I think we are working too hard, and we are missing something, how to manage the finances, and we don't learn that one. So Peter, I will just give this podium to you, so maybe you can introduce yourself.
Sure. Yeah, thank you, Nawaz, and thank you very much for inviting me along. I really hope I can add some value and information to you and to your community. I have some slides and illustrations to be able to put into context what it is I'm talking about. I tend to work like that. I work with pen, drawing out images, illustrations, showing image and so forth. So if you wouldn't mind, maybe you could allow me to share the screen, and I can do maybe a little bit of introduction about myself, a bit of background, and after that you can begin to ask questions in the context of what you're hoping to get information on.
Sure, Peter, I have given this permission to you, so maybe you can start sharing.
Great, thank you. And just a moment. Yeah, thank you. Well, as you say, I'm 30 years in the industry of financial services and financial planning. I used to work at KBC Bank, and I was in charge of working in management in asset finance and corporate finance for machinery and equipment financing, and also relative to introductions for commercial mortgaging and corporate lending. And I set up my own business in 1998 as a financial advisor, broker, where I was able to help people work the work that they do and help them to able to put in financial solutions as relative to their circumstances. This involved, of course, as and it's how one of the first ways I interact with people is through as a financial advisor and broker, giving advice and product solutions in relation to finance, pensions, savings and investments, life and illness protection, whereby we can provide the best value and most logical solution by having a range of providers with the best products available for that. And this is the way that most people interact with financial services. They just see it tentatively, naturally as should I have a pension? How much protection should I have? How much investments should I have, etc.? How much should I be saving and things? And these are natural questions. And that's the way that most people, it's the way the world works. But when I set up the business, one of the main reasons was I wanted to work with people, focused more so than product and target focus. And while finance is very important part of society and for commercial growth, working with people and people's problems and helping them solve solutions, whereby the product might be a tool in the box, so to speak, became more important. Because when it comes down to it, we're all working towards the same objective, which is effectively to be able to make the most of what we have and create the type of world that we want. And so often the answers are not so much in the products, but they're in how we interact with money. And this brought me into the world of lifestyle financial planning, whereby I was taking my exams to become a qualified financial advisor and then a certified financial planner, and using technology in order to be able to help me to be able to give a more comprehensive service to everyday people who are working in employment, who are working in self-employment, who are working in contracting and working in all circumstances, but also people who are not necessarily working, or spouses of the people who are working, and how we can get a better and more comprehensive solution to what they what people are striving at, is making the most of what we have. And lifestyle financial planning in itself is effectively about how we manage our money to be able to achieve the aspirations that we have. When you think of money in the center, it actually revolves around whether or not how we can where we can live, the family that we will have, the type of work that we'll have, education for our children if we have children, illness, if we want to go on holidays, if we want to retire, all of these things. And because there's money going in and out of our life all the time, it's very, very difficult to keep track. A year can go by very quickly, 10 years can go by very quickly, without realizing, in fact, that we maybe have missed a trick, because we have money coming in through salaries, and we have money going out through lifestyle, debt and expenses. And whatever money we manage to save, we call it savings, we call it investments, we could probably have it in property or pension funds, business, and so on. And all this is happening all the time. In the future, it even happens with the state pension, other pension benefits you might have, and you have outflows of retirement plans, you have cost savings. And this is where so often we get conscious of, I really have to take this seriously, I really have to look into this. And time passes after 3-4 months, and then it goes. Maybe with a financial review, people get serious about it again, and then after a while, it loses track. So this is why I specialize as well in lifestyle financial planning, because it's about what you want, dealing with a major issue, to make provision in the sense of if you want to provide for illness or debt, to be able to make informed decisions about your assets, income, interests. People might have property. Should I sell one property? Should I buy another property? Should I save for a car? What should I be doing in order to make sure I'm not going to run out of money during my retirement? So lifestyle financial planning delivers these attributes. A retirement plan within your means helps you be able to have your financial affairs managed and in order, help you protect your business if you have a business, and your assets if you have assets, estate planning, tax efficiency, integrating your business and career into your plans, to know where to invest. To do that, it's quite complex. I used software and researched through most countries, actually. South Africa, Australia, Holland, and America were leading, but in fact, I discovered software as well in Europe, in Britain, Presswood software, which is excellent to being able to track all the money throughout life. When you give your idea of what you want, by way of, for example, I want to buy a car, it'll cost X amount of money, and I want to be able to have a family, I want to be able to buy property, I want to be able to put money away for this, that. All these financial thoughts that we have and all these financial benefits we have, such as income, to measure that with our aspirations, we use software to be able to draw out a lifeline of the money that you have from whatever age you are to whatever age forward that you want. And we're capturing all the money that comes in and out into what we call the financial, of human capital. This can be presented then graphically for discussion, and we can see whether or not somebody's going to run out of money. And if that's the case, we have to take action. We look at different positions that they have, at what stage they're going to run out of money, and we can run what-if scenarios. And from those scenarios, we see solutions, and we line them out. For example, in this situation, what if you sold the business for 275,000 at the valuation that it was at the time, maybe and retired at 65? It brings you from that position to this position, which effectively means, that you would not be running out of money. And this software and this methodology of financial planning allows people, most importantly of all, to make financial decisions. And that's the big question. Should I spend my money here, or should I put my money there? By using this sort of methodology, we're able to get a proper and independent, if you want, an objective idea of what the solution would bring if we took that action. Now, this led me on, as I was dealing with a lot of companies, businesses getting equipment, machinery, financing it, and they were asking me to look after their financial affairs. We often found that in many situations, the business owner is constantly looking after the day-to-day running of the business, and the people and the suppliers and the credit and the marketing and all the other issues that come along, as well as have a life, and so often people would find themselves in situations that their ambitions were not going to be reached from the financial resources that they had accumulated and were going to accumulate, because they're so busy in their work to be able to get around to that. And from that, we would have discussions, and we say, okay, you're coming up short. And why is that? And they would open up at how the business is going, what issues they're facing, and what opportunities are there, but they haven't got the time to get around it. And we would talk to them through and I would question their answers, and then they would answer more, and we would have this discussion going on for a week to, within 2 to 3 meetings of the financial planning meetings. And from that, they would take action. They would feel more confident of taking certain actions, and those actions were bringing results. And this brought me into what actually is essentially a business and wealth financial planning. And it just made so much more sense that if you're helping people with their finances, and business or their career are part of the finances, in fact, they're a major, major part. If somebody's earning 50,000 a year and they have 30 more years for retirement, they're going to bring in, even without promotions, 900,000 euro in today's money terms. That's a lot of money. And if they're able to increase their income by 5, 10, 15% and so forth, whatever it would be, the money increases, property increases. There's a lot of money that's actually involved in the inflow and outflow of life. So by working with them, I found that all the questions that they had, we were able to discuss through issues and solutions, and step by step, getting from where they wanted to be to where they were to where they wanted to be, without having to go around in circles. And I created then for them would be seen as a success path. Effectively, we look at the ideal lifestyle, build sales income, build business systems. A lot of this comes from my own marketing background from university, from working in business, and from myself, and the study of systems and marketing strategies. creating the finance and the revenue resources within the business, and the opportunities for wealth extraction and succession planning, which would lead into the lifestyle that they have. So they have a better lifestyle today and also in the future, and they can plan out future adventures. In order to do that, strategies, I put together systems to allow me to bring in sales and marketing strategies, business growth strategies, wealth extraction strategies, and exit. So the whole lot can work in conjunction, because as each year goes on and progress is made, there's constant new decisions to be made and opportunities. So that's really the background where I am. I work, as I say, with most people through being a financial advisor and broker, and or lifestyle financial planner, and or a business and wealth financial planner, and or people who already have their finances organized through other sources or other contacts and advisors. They may want a second opinion advisor, and again, I'll be able to help them out through that means. I'm living in Selbridge, family, 4 children, and effectively this is the work that I do, and I really enjoy it because it helps people change their lives using advice and solutions. So that's really where I'm coming from.
Thank you very much, Peter. This
welcome.
This is very interesting. You are going to change ICT professionals' lifestyle.
if they want. But of course, but yeah.
we are actually like, we are hard worker community, and we just go in one direction and we put all our effort. And although everyone's desire is to think about money, finances, but I think we are too much loyal with our work.
Okay,
so,
that's a common but at the same time, yeah, I can understand that people, yeah.
So since I just shared the agenda with bigger audience.
Oh yes.
And we are going to talk today about protecting our future and saving money. We're going to talk about pension. We're going to talk about business exit strategies and how you can build the wealth.
Okay.
And the last one is a 5% game changer.
Okay.
So maybe we will start from protecting the finances and saving option. So these are the common questions which I had gathered from a couple of guys here. And I will say, if any one of you who joined this meeting or on the Facebook, if they have any question, please do post, so we can ask Peter input on that one. So Peter, from the first question, what we just built for you is like, what's the best way to protect myself and my family? So I'm just saying is, in general, is if anyone who is like working and living in Ireland, and what's the best strategy you will advise us?
Okay.
It's very open-ended question. So
it is, yes. It's in relation to protection of your money and your income, yes?
Yes.
Okay. Well, the first thing you have to look at in relation to that is you have to look from the perspective of what is available, because so often we can actually be brought into the world of products and hear such lines as, you can never have too much life insurance, which is wrong. You can actually have too much life insurance, and so often I've had to actually advise clients. See, all these protection products are all based on replacing an income that is no longer going to be there in the event of a tragedy. And for example, if in the event of someone dying in a family, and that person is bringing in an income, if the person is married or has a civil partner and is entitled, they'd be entitled to a widower's pension, which at the moment is running in the region of about 11,000 euro a year. This has to be taken into account. You may have company pension protection from way of accident, sickness, and also life, death and service cover, which can be up to 4 times your salary. And this has to be taken into account. Have to be taken into account any other benefits that could be available, such as your own savings as well, or other, so relatively speaking, the level of life insurance and illness cover that you have is relative to the level of income that needs to be replaced over the dependent years. So a family that, for example, has very young children, you're looking at allowing for your own aspirations as to what you want for them for the future and how much it would cost. So it's a calculation calculations that have to be made with what benefits are available, what money is available on one side, and what are the needs on the other side. And these things should be taken individually on specific and commonsensical approach. Now, rather than actually spend quite a long time on protection, but and on the individual products and the differences. But I don't think that's what this forum is for about. So what I'll do is maybe show you an example of how you can look at how you can view money in order to be, and how the differences of approach can make a significant difference to the results. And I call this rainy day money, which is about, in this case, it's two individuals in their 40s, and they've decided, they're putting €400 cash away every month to have something for a rainy day in case of an emergency, in case of illness, inability to work, maybe even an event of death. What's the best way of putting it, of using that money? Now, in the first place, he's putting in his money into a savings account because he doesn't believe in putting it into things whereby you can't see the value of it. For example, if you put it into a term insurance, life insurance policy, you don't get anything back, on that particular life insurance policy. So you're putting money in, and if you don't die, that money is gone, and he doesn't necessarily see the value of that, which is understandable in one sense, but then we put money into car insurance and house insurance, and every single year we don't get any money back. But what we have is a peace of mind and the legal obligation, of course, in relation to cars, and in fact, to cover for your mortgage, the house insurance. We're putting money into a policy that is going to pay out in the event of something drastic happening. But he's putting his money into a savings account. He wants to see, and if something was to happen in 3 years' time, 400 a month, a little bit of interest, that's €4,800 a year. It's about 15,000 in his bank account, which is not too bad. And if she puts some money into savings account and policies, and something was to happen to her in 3 years' time, let's say the same misfortune. Let's say, for example, unfortunately, both of them got maybe a serious illness or no longer able to work, whatever. But she'll have access in her planning with over €1.3 million. And that's made up of policies and savings. She'll have nearly 9 times more access to more money by way of, she's in her 40s, and with a plan for income protection, which is protecting the income that she's, and in fact, just go over those quite briefly. Income protection here is protecting literally the income that you have coming in. It is, the premiums are paid, but you get tax relief at your marginal rate of tax, but the payment comes out. When it comes out, it's paying you every month for the period that you've chosen that you want to cover up to a certain age. So in her case, it's 20 years. So she has 17 years or so to go when she gets into misfortune. And but the income that comes out is taxable. So you get tax relief on the money going in, but at the same time, you're taxed on the money going out. Life insurance, on the other hand, there's no tax relief unless it's pension term insurance, but there's no tax relief for normal life insurance. So it's a cash payment, and serious illness cover. That's covering all illnesses, of serious illnesses, from cancer, heart disease, stroke, all those type of illnesses, and they are an immediate payment as well. There's no tax relief on the premiums. Premium is a payment for the policy. There's no tax relief on the premiums, but there's no taxation on the benefit either. So in her situations, she will be getting 40,000 a year if she had 17.5 years to go before retirement and she was not able to return to work and she's been able to prove she's not able to return to work, that continues to be paid to her and she'd get access to 700,000. If the reason why she's no longer able to work was because of a serious critical illness, as I described it, stroke, heart disease, cancer, whatever it may be, and she recovers, she still gets the money. Once she's been diagnosed with the illness, she still gets the money, tax-free. But if, for example, close to maybe her 60th age, which is what this policy example illustration just shown up, if she was to die because she took life assurance with the serious illness, she gets another 300,000 into the estate. So effectively, her family or dependents are going to be benefiting on herself. If she survives, is €1 million access up to, and 300,000 goes into her estate if she was to die it, and the cost of them would be 120 and 80 and 25 euro, which, as you know, is 225. Now, I use an example of he was putting 400 euro a month away. So if she was, just to compare directly one-to-one to herself and himself, that would leave her 175 euro a month. So if she was diagnosed or in those conditions, she would still have 175 euro to go into every month over 3 years. So after 3 years, she's technically could be a recipient of up to 1.3 million euro. And that's really what it's about. This is like financial planning in action. It's not about products. It's about both of them have the objective of having money for a rainy day, and the results are different because they planned about it in a different way.
Wow. Peter, you know what? I don't know. I'm just going to talk on my behalf.
Sure.
We really just think about to buy a small plot or land back home. And we always have a dream that will increase, but it will never increase the way you had shown us, like 90 times or 900 times, I don't know.
Yeah, it's like saving in reverse. We'd all like to have €1 million if something went wrong, and if you start saving for it today and we put 20,000 euro a year aside for it, that takes 50 years to get it. And the reason, what's the objective of the €1 million? Oh, to look after the family and everybody if something happens to me. Okay, well, how about take out a policy and you're saving in reverse? In other words, there's access to €1 million for your dependents, and it's going to cost you. It could, cost you, relatively speaking, it'll cost you a fraction of what it is. But that's, again, as I say, this is about perspective. It's about, it's achieving the result, and it's just looking at it from a different perspective.
So this means that is if like we usually don't think on that this side of the world, and if someone is sick, someone is whatever, they had accident, cannot work, and we have only one option, which is the state funds, nothing else. If you are living in Ireland, and interesting. So Peter, this is great. So what's about the savings? Is there any way like if we are working and we are just whatever we are earning, we are spending on ABCD, and here we are just investing into the policies, protections. And is there anything you should consider about saving options? How we should save it?
Of course. Okay. Okay. There's such a variety of ways to save money, as you know, and the younger you start, naturally enough, the more of a habit it becomes, and a good habit it is. But all these things are relative. In fairness, people that are in their 20s, they don't necessarily be thinking of retirement, so they're not really putting much money away for retirement because their objectives are effectively lifestyle, relationships, perhaps even starting a family. And at those points, the priorities are there. Protection first and the reason why I say protection first is quite simply that we are the machines that produce the money. Whoever is actually producing an income, if the inability to produce an income anymore means the machine stops. So So naturally enough, certainly, as I said, there are benefits there from state, there are certain, up to a certain point, and there are benefits there from companies or employments that could be there. But the second part of it in relation to savings, for short term, people at a younger age will be saving towards cars, mobility, allows them to be able to work in different places. Education, extremely important. In fact, it's the biggest and best investment you're going to make in yourself, is to train and be able to offer more value to the world. And in return, hopefully, not always, but that you will get value back relatively in remuneration. And after that, providing for security for yourself by way of home and ability to live lifestyle, and then after that for retirement. I suppose actually in so many ways, while people will be familiar with the normal routes of investment in relation to banks and credit union savings plans and so on, interest rates being low, people are interested always in looking at how you can make much more money, making money work for you, as the expression goes. Well, realistically, financial planning is, when it's down to risk management, because what we're looking for when we look for more money is we want to reduce the risk that we can't have the life that we want unless we have more money. That's why people tend to look for more money. But what I'm saying is use utilities of the money that you have with a bit of strategic planning and make it all affordable. So what I can do, in fact, is show you an example in relation to pension planning, whereby we can look at the possibility of the starting a pension with, let's get rid of those things for a second. Oh, this is what you can afford. I beg your pardon, just one moment. Are you seeing everything else? I'm looking at on the screen here.
Now I can see only financial planning in action.
Okay.
You see this 15,000 or 1.3 million.
Okay, just one moment then. I'm just going to share and share here. So, a bit of pension planning. Can you see this?
Yeah, I can see this one now.
Excellent. Okay, we're going to aim here. This is, and I'm conscious of time. By the way, I'm going to run through quite a lot of this now at this stage, because there's quite a lot to be covered on. And what people can do is use the replay. I presume this is going on, that people will be able to access again. And therefore they can watch it again and rewind what they need to. And also, if of course, by all means, please, if you want to get further information or discussion and so forth, and I can send you on information, or if people want to contact me directly, for to elaborate on what we're showing here. So I'm going to just use a simple example. If, for example, people, as you say, don't necessarily be thinking of retirement, particularly in the 30s, 40s, 20s, 30s, 40s age group and so on, and maybe even into the 50s. But if we were to look at the current aim for a particular target of, say, 36,000 a year for a couple from age 65 onwards, I'm using this illustration simply because it's tax-free income up to 36,000 if you're aged 65 onwards, even if your partner or spouse is actually aged less. And after that, it's marginal rate of tax. In fact, you can be earning up to 70,000 a year. I think it's still less than 20% relative tax for a couple that's over 65. But if the thing about planning for money, or where you should put your money, is what's the objective? The objective is that I want to stop retiring. I want to stop working someday. And often people would say, I'd like to, start a pension, and I often say, why? I kind of stumped them, because they kind of go, well, because I'd like to stop working. I say, okay, when? And they go, well, I don't know, and so on. So it's very, very useful if you have an idea of a simple target, and that once you, it's like, as you say, saving a few euro, once you get into the habit and being able to see the benefit of what you've begun, you can then grow upon that. In this situation, we're looking at creating a pension or a retirement income of 36,000 a year for a couple age 65. The first thing we do is we take a look at the state pension that they're entitled to. Now, if you're working in Ireland, you're paying PRSI, depending on the amount of contributions you make will reflect in the level of pension that you have. Since the system changed through accountability by Marshall about 12 years back, 14 years back. It was after the time of the big recession of 2008, 2013. But a single person, if person's work is 253 a week, if their spouse is not working, they still get 227 if their spouse is over 66. If they're under 66, it's 168 until they become over 66. So if two people are working, it's practically 500 euro a week, or 25,000 euro. If one person, it's about 24,000, 23,000 or so a year. So we take that into account. If you're going to achieve for 36,000 euro, we're looking at 24,000, say, coming from state pension, 12,000 coming in from your own private pension savings. That's 36,000 a year. We're going to aim to build a pension fund of 400,000. The reason for that is very simple, and I'll show you in a moment. Now, a lot of people say, what's it going to cost me? The relative cost, if you're a 40% taxpayer in each of these instances, and you're a couple, from age 30, if you're just 30 years of age and you have nothing already provided, 156 euro net, which is 260 a month each gross, so that's 520, but you're allowed tax relief. In other words, you pay 40%, you get tax relief at 40%. So out of your pocket, out of your back pocket is 156 euro each a month. And if you're at 14, you haven't started yet. To build this 400,000, 214 each net. And if you're age 50, even if you haven't started yet, don't panic, 500 euro each a month net, and relative to a growth rate of 6% minus management charge, because remember, all pensions, all financial products and solutions will have a charge on them, and this can be remuneration towards the investment company and also towards the advisor, people like me, people are brokers and so forth, who are not paid a salary from the investment company, so they're given commission, and that's already built within the product. In fact, if you go directly to the institution, whatever financial company it is, rather than through the broker, you'll still be paying the same price. The difference is that you're getting, from brokerages, you're getting a choice of the best and the most appropriate best value product. So that's just by way of explaining that advice, the charges and so forth, you can be paying a fee for financial advice.
Peter, just to clarify this one. So you're saying that no matter if I will choose a broker or if I will not choose a broker, the cost which it's going to cost me is the same.
Yes, because you see, it doesn't make sense for a financial institution to be distributing services through brokerage if they're going to offer cheaper if people come directly. So therefore, and on the other hand too, it doesn't make sense for them to be paying brokers a salary, everyone the same salary, and yet only some of them are given a business. So it's, but that's life. It's like, for example, if you buy a Mars bar in a shop, you're paying money for to the shopkeeper and to the distributor, to the wholesaler, there's a lot of people along the line. It's all cut in there. So in our businesses, in financial products, it's called commission. In accountancy business, they call it professional fees. In the workplace, they call it a salary. It's just remuneration for the work that you're doing. So just wanted to be, so what we're talking about here is 6% growth minus 1.25%, and it will cost these levels in order to be able to accumulate 400,000 euro. Now, what this comes about is that you have 24,000 from the state, 12,000 from the pension coming out, giving you 36,000 a year. Now, the reason why that comes about is this: that if you build up a fund of 400,000, the government would allow you to take a tax-free lump sum of 100,000 euro. The maximum tax-free is 200,000. After that, you pay 20% on the lump sum. Don't worry about that. That's a different conversation. But effectively, in this situation, 400,000 is the lump sum, or is a pension fund, 100,000 lump sum, and that if you take out a modest, well, let's just looking at, you can take as much as you want from the remaining 300,000, but you're going to be paying income tax, PRSI, USC, relative to your age and the time that you took it out. And it would be prudent to take out a certain level, and this is what this planning is about. You're taking out 12,000 a year, and if your pension fund is worth 300,000, and it grows, say, you put it into a modest investment. Most people stay with the same pension company, or that they took it out, so their fund stays there. But with a reasonable strategy, you should be able to achieve 3-4% a year growth of that 300,000, and then you draw out 4%, and then it goes up 3 or 4% again the following year, and then you draw down. And so, relatively speaking, it should be able to hold its own value. Otherwise, it'll bottom out. This is where financial advice and financial advisors, people like ourselves, come in. But at the end of the day, pension fund is 400,000, 100,000 tax-free lump sum, and then you have the balance. You can take out an income from it as much as you want, but prudently, we're looking at 12,000 a year here. So what this has achieved by if you have no pension at all at the moment, what is it going to cost? These are the relative prices it would cost, at this growth pattern, in order to be able to achieve 36,000 a year. Now, I mentioned to you, and I think you put it down, maybe in some things that you were into, in relation to taxman, the helping hand. So I'm going to just go into this very quickly. If you put in €400 a month into a personal pension or PRSA over 30 years, you're going to put in 144,000. You're going to get tax relief at 40%. So your after-tax contribution out of your back pocket is 86,400. In this situation, if we were to take it that over the 30 years, the estimated return on capital built up at, if it's a 6% investment return, 1% management charge on a standard PRSA, is 308,000. Tax-free cash is 77,000. Now, this is where it gets interesting, because what's happened here is you put 144,000 in, it's worth 308,000. You're allowed to take out 25%. That's 77,000, which is effectively 90% of your outlay. You put in 86,000 out of your back pocket, you took out 77. Put in 86, took out 77. More than that as well, because you put 144,000 in gross, you got tax relief. Technically speaking, the taxman is giving you back, or is adding 67%. In other words, you put in 86,000, but really 144,000 overall was put in. So that's how one way of looking at how the tax advantage of pension planning. Another aspect is a lot of people are working for companies, and employers may say, if whatever you put into your pension, we'll match it, or if you put in 3%, we'll put in 5% or whatever. In this case, I'm looking at an employer putting in the same as an employee, €400 each. Okay, so they say if you put in whatever percentage in, and the employee agrees, I can afford 400 a month, I'll be getting tax relief on that, I believe, from 400 a month, and they put in 400 a month. The employee has put in 144,000 again, okay? And out of pocket is 86,000. But look at this. The actual fund is going to be worth 616,000 because it's double what we saw here at 308, because there's not just the employee, but also the employer putting 400 in. The tax-free cash is 154,000, and the balance that's left after you take the tax-free cash out of the fund is 462. Now look, that means that the employer and taxman effectively are adding 235% to your net outlay. You put in 86,000. They put in net out of your pocket. No, you put in 144, you got tax relief.
Sorry, Peter, can you just employ gross outlay? What is this? This is like an anniversary?
Yeah, employee gross outlay. That's like, for example, if you put €1,000 into a pension, your gross outlay is €1,000. But if you're a 40% taxpayer, it means that you're going to pay €400 less tax at the end of the year because you put that €1,000 in.
Got it. Okay.
Okay, so your gross outlay is what the money you're putting in, and but at the end, because you're getting tax relief, your after-tax contribution is your net outlay here. Okay, so if this costs you out of your back pocket 86,000, but in fact there was 144,000 plus another 144,000 put in. In other words, your employer put in matched you, and you also got tax relief of 56,700.
Got it.
On top of that, you're also getting, look at this, you put in 86,000 out of your own cash or your back pocket, and tax-free lump sum was 154,000. You put in it cost you 86 and put in 154. Now people say, okay, wow, okay, that's fantastic. Can I afford that? But we'll talk about that in a second. The thing about it is that technically, tax planning, and this is one form, this is in pensions, there's other forms and so forth, is a very effective way of getting a good return on your investment. In other words, work within the rules that's there. You can actually get greater returns through logical. This is very, this is not super returns that we're looking at, but work within the rules. The other thing about this is that in this instance, there's 462,000, and if they only draw down 4% a year, 18,000 income a year as well from that. So from putting €400 a month away for 30 years, 18,000 a year is coming back. And if that person lives on for 10 years, 184,000, 20 years, 360,000, 30 years, 540,000. And if their fund is growing more or less at the same rate that they're drawing down, they still have, relatively speaking, 462,000 after taking out $500,000. So that's how money works. Now, simple question, people. Yeah, sure.
Just one question. If you can go back to the previous screen.
Sure.
So this 462.
Yeah.
So this is whatever the money I will withdraw.
This is 75. This is 75% of your fund.
I has to pay the income tax. Yeah.
Oh, that is taxable. Of course, yes, it is. That is income. It is. So you add that. Yes, it is. So in that case, yeah. And you don't have to take out 4%. You can take out 5-6%, but the government requires you to take out a minimum of 4% for the simple reason that a lot of people over the years had built up massive pension funds, worked into 7 figures and 8 figures and beyond, and so on. And the government said, we have to, how can we tax those massive funds? So they said there's going to be what they call an imputed distribution. In other words, we're going to take taxation on the equivalent of 4% of your fund, whether you like it or not. And and that's the reason for it. And so therefore it makes sense that you draw down 4% at least a year, because you're gonna have to pay tax of 4% of its value. So you draw down 4% and you pay the tax. But yeah, all income coming in after your tax-free lump sum, all income from your
so if I want to withdraw 462 at one go, that's possible.
Yeah, but but I would send you to the doctor before you do that, because that would be crazy. You are talking about you're going to be paying, you're going to give away half of it back again to tax. You're not going to keep half of it, because you'd be taxed on it fully. So you wouldn't be doing that. What we'd be doing is drawing it down in a prudent and logical way.
Yeah. That's what the magic I want to learn from you.
Sure. Here's some quick questions people ask. Can I, they're afraid, should I start a pension? You can start as low and as increase as you want. You can put in lump sums if you want anytime. If things go bad, if you lose your job or things change, you can stop, you can reduce the premiums. Okay. Now, granted, unless you are terminally ill or extreme circumstances, you cannot retire and therefore draw down your pension before the age of 50 in a company pension plan, but you can actually reduce the premiums. You can stop the premiums at any stage. But people do often be afraid, and I can understand it too. If you put money into the pension, you don't get it out until you draw it down. So, but you can reduce and you can stop the premiums. If you die, your inheritors can keep it, therefore it stays in your safe. If it is through, they're called Approved Minimum Retirement Fund, the Approved Retirement Fund, ARF. The AMRF is disappearing. That's another discussion for another day, but effectively the AMRF and the ARF are all part of the pension fund. So what it means that if you work all your life, you're drawing your pension, you die, it can stay within your estate, as long as you haven't taken an annuity. If you take an annuity, that means you're getting in. Again, this can get complicated, but it's a different way of drawing down your pension, and you can pass on the benefit of that to your spouse so that she or he gets it if you die. The annuity route, but most people draw down in the route I showed 25%, and then tax-free lump sum, and then the balance in investment in an ARF, and they draw down a percentage every year. So it can stay in your estate, your spouse, your children can benefit from it. There's taxation thresholds, that's a different conversation again, but effectively you're not losing it. Can you switch funds or life company? You can, of course. And can you emigrate with it? Which is, of course, very important. Yes, you can. And not only can you emigrate with it, you can be taxed at your country that you're emigrating to, which, because if Ireland has a double taxation agreement, which means Ireland won't tax it for you, you just pay, you sign a PAYE exclusion order, and you're taxed in the country that you're receiving it, that you are now domiciled in. Another part of this is that you also are entitled to state pension if you're working in Ireland, and whatever the pension relative that you are entitled to at the pension age. And you're living in another country, you've emigrated, maybe, you know, and you again can contact the department and tell them to send the money on to that country as well. So these things are very important when
wow. I think this is what is a beautiful, like, especially I think most of us who are sitting here is working from the last number of years. So the takeaway from here is state pension. If we will immigrate back to wherever we came from, we can get the state pension, and if we build up our own private pension, I will say, and that the whole amount can be transferred to another country if there's a double treaty, or what you call it,
a double tax agreement,
double tax agreement.
And there is, like in Pakistan, of course, there is. I mean, I think the last one, it's been updated from the 60s. Then we joined the EU in 73. There was one there, and then there was another change made in about 18 years back. But the most recent one, 2016, 2017, and it's there.
So Pakistan is there.
Oh yeah. In fact, Ireland is actually, it is.
So I'm just going back to just to reiterate this one. So if I have a fund of 400K, 25% I can withdraw with tax free, which is 100K. 300K I can transfer to Pakistan. Yeah.
Or you can even keep it in Ireland and get the income from Ireland sent across to you, but it won't be taxed in Ireland. It'll be taxed according to your Pakistan taxation,
Pakistan taxation. So like, like different countries have different tax rates. So like if I will go to Dubai or anywhere, they might have 5%. So this means that I can save more money?
Yes, if they have, Ireland has a double taxation agreement with them. Yeah. Okay. That's what it's about, Yeah.
That is the financial strategy, Peter.
Yeah. Now, I'm just looking actually conscious of time here, and I think that there's a number of things that we'll be able to cover. All I want to do is, I think, cover something in particular that when I was talking to you about it originally, I'm going to do screen share here. I'm going to cover it as quickly as I can. Because it is here we go. This is about how effectively financial planning can create. This is comprehensive business and wealth building program. Now, a lot of people, and the reason why I'm bringing this in because you mentioned, when we were talking before, how people who are in business, you're so involved in your business and your work, you don't often get time to actually be able to plan out how best to use your business as part of your future. And what I'm showing you here is effectively using the success path that I have designed for clients and be able to bring about an increase in somebody's personal wealth by over 1.3 million in 10 years from a 300,000 turnover business. Now, this is maths. We're looking at maths here, We're not looking at promises and outrageous statements. We're looking at just pure maths and the laws of business, taxation, and investment. Now, the case study involved at the time a client aged 57. He was running his own business. He had a 300,000 turnover. And he was working every hour of the week. He said he was working 70 hours, but I know he's working over 100 hours because anybody who's self-employed or people who are even contracting and they're actually ambitious to actually grow themselves and their work, they're spending a lot of time, their free time, thinking about business, thinking about solutions, thinking about problems that they have and so forth. So physically, you might be in front of a computer or you might be in a yard or in a lorry, whatever it is, doing your work 60, 70 hours a week. But really, mentally, you could be doing over 100 hours a week and so forth. And he was... So he's not unusual. Most people actually try to do this, to try and have a reduced staff, doing administration, payroll, etc., saving money, not being able to see. The reason why you set up a business is often that you can win clients, win contracts and so forth. But in this situation, he wasn't seeing his extra clients. He got used to looking after inside the business rather than just working outside it, as the expression goes. He hoped to retire at 66, but he couldn't see it happen. And he had 126,000 in the pension fund at the time, putting in 20,000 a year plus 5% indexed. And that means 20,000 will go in this year. Next year, he plans to putting in 20,000 plus 5%, which is 21,000. The following year, it will be 21,000 plus 5%, etc. Now, his challenge was how to retire in 5 years. We did the maths on it, and we were able to discover that with the pension contributions that he was putting in, he's going to have 126,000. And the fund will go up to about 440,000 in actual terms. So this is extremely important expression here, actual terms. Most people talk about growth of a fund, and even I've shown you there an example of growing to 400,000 euro. That 400,000 euro in 10, 15, 20 years time is not the same as 400,000 today. You buy a house today, 400,000. In 10 years time or 30 years time, you're not going to be able to buy the same house for 400,000 if the economy keeps as it is. So what you can do with the software, for example, that I use, we can actually bring it back to actual terms and build inflation into the software. So therefore, if they're looking at 126,000 in today's money terms, with the growth pattern, I think the growth pattern is taking some region of 4.5%, 5%, 5.5% in this instance, minus charges, but brought back in today's money terms, it's 440,000. So you're looking at the pension at that time was 126,000, and the actual pension fund return is less than 1.5%, because we're saying how much will you have in 10 years time? You have 440,000 in today's money terms. You understand? If you're putting money in each year and it's growing, and then you drag it back for inflation. I think we're on inflation at about 3% average here per annum. So in real terms, 126,000 today. How much will I have in if I continue what I'm doing? I'll have 440,000. Now 440,000, as you said there yourself, 25% tax-free lump sum, 110,000, and therefore that leaves him with 330,000. And if he's drawn down, he'd have 330,000, and if he's drawn down at about 3% a year, he'd be drawn down 10,000 income a year. And that would mean that within his financial world, his aspirations, he was going to run out of money before 90 and not have a massive amount of money in the meantime before that, if he retired in 10 years as he expected from his age 57 to 67. So our calculations show that if he put in extra funding, more than what he's putting in, of 365,000, he could retire at 67 without fear of running out of money. And this was shown in the cash flow, lifelong cash flow forecasting software. So we put in sales and marketing, business growth strategies. Now, these things are constantly evolving and changing and so on. In this instance, we looked at a situation whereby he would outsource the administration work that he was doing. That was keeping away from speaking to new customers, new clients, and getting new contracts. That was going to cost 250 euro a month. And that's why he wasn't doing it, because he said that's 3,000 euro a year. But I was saying, from the perspective, 3,000 a year, what is that going to, relatively speaking, what can you create? Could you even create a 5% increase? And we ran 5, 6, 7%. And we saw, right, if you increase your turnover by that amount, you'll have costs associated with it, you'll have, and then after that you will have what you call profit or revenue, you know, to yourself. And we're able to figure out that basically if you outsource the payroll and bookkeeping, freed up time to increase the focus on new clients, increase turnover by just 5% a year, from 300,000, 15,000, and we'll keep that 15,000 constant. We won't even bother compounding that. He would have be able to invest surplus income into current pension funding and be able to provide retirement income, so that in 10 years' time, he'll have increased the current income as well in the meanwhile annually, and he'll also have increased the value of his business if he sold it, because he was intending to sell it. You know, there are 9 ways of actually getting out of business, and that, you know, there's 8 real ways while you're alive, and 9 ways is dying. But I mean, but effectively, business planning and future succession planning is extremely important. In his instance, he was going to sell it, and he's seen his business is my pension. He had that mentality, which is fine, except it wasn't looking like he was going to have the money. So we brought in these strategies in this instance. You know, we brought in other strategies as time went on and so on, and things moved at a much faster rate as well. But these strategies allowed him to be able to plan for the future differently. Turnover is 300,000, increased by 5%, 15,000 increase in turnover. Out of that 15,000, 6,000 was going to be variable costs, which is his average. He was working on 40% variable costs for it. And the accounting services, bookkeeping services, 3,000 a year. We were going to give him an extra €1,000 a year one, so they could see some value for this change, and 5,000 extra was going to go to his pension. In year 2, 330,000, another 15,000. So of the extra 13,000, 12,000 was going to go into variable costs, 3,000 towards the accountant, 3,000 salary increase, you know, and in year 2, it is year 2, 12,000 going in extra to pension. So there's the 30. So went from 300 now 315, and then at 330, 12, 3 to himself, 12 to his pension, and over 10 years, his turnover will increase to 450,000. Okay, of that, what we're looking at here, first of all, is that the additional after. I'll just go back here on that. Just nothing actually. These things are all mathematical. You know, 150,000. His turnover's gone to, in year 10. So turnover's gone to 450,000. After 150,000, expecting, you know, 60,000, 40% of that will be variable overheads. Now I know people would say yes, prices increase and inflation and so on, but this is in actual terms we're talking about. So so if his turnover went up, say, to 480, 500,000 by year 10, relatively speaking, his overheads will have increased marginally, his accounting services will have increased marginally, income and so forth marginally. But just keeping it at the mathematical as it is, it would mean that instead of in year going from 20,000 to 21,000 going into his pension, in year 1 it's going 26,000 of pension. And instead of going from 21 to 22,500, you know, the 5% indexation that we had, it would be going to be an extra 12,000. So 34 going into his pension. 42, 51, 60, 70, 79, 89, 100. And then the final year, which is not a full 12 months at the time, was going to be 96,000 going into his pension. If you add all these additionals that came in from the relative increase of 5% increase in turnover, 5, 12, 19, 26, and so forth, comes to 365,000 extra pension funding. Now, this is where it comes very serious. His pension fund has increased. His pension fund that he's going to have at the end of the day, before the tax-free lump sum, will have increased by 427,000 to 857,000. The tax-free lump sum has gone up from 110,000 tax-free lump sum. If you remember back here, where is it? Here it is. Here's the 440,000. You see, for 40, instead of being 110 and 10,000 to pension, it's 214,000. Now, because it's 14,000 beyond that 200,000, remember I said the tax-free lump sum that you can get, the maximum is 200,000, and after that, anything over the 200,000 has to be taxed at 20%. So he's going to be taxed at 20% on the 14,000. So he'll have 3,000 tax due on that roughly. But it's gone from, so he gets tax-free lump sum of 110, increased from 110 to 214. And his pension income, look at this. That's now, instead of 10,000 a year, it can be 33,500 a year. He's drawn down a slightly bigger margin. I think it's about 3.5%, 4%, because there's much larger fund there. Therefore, he has, you know, in other words, a better provision and better lifestyle. Now, what this comes down to is this: turnover increased by 450,000. Okay, extra income for him. Remember, I told you he's getting extra income: 1,000, 3,000, 5,000 out of just the relative increases in the turnover. 100,000 extra income coming in. He changes from this position to this position. He's getting an extra 100,000 income, 104,000 extra tax-free lump sum, 705,000 pension income if he lives for another 30 years. So in other words, if he lives from age 67 to 97, now he may not, but his wife may do so. And people say, I often say we should maybe do your financial planning up to age 100, and they go, I'm not going to live to 100. And I say, maybe you won't, but maybe your husband or your wife will, or whatever it would be, you know. But I said one thing's for sure: money doesn't die. Money does not die, and if you don't look after it, it'll go. You know, taxation will take a lot of it. You know, so basically, you know, or you can plan it out with your estate planning and your gift planning, and legally hold on to it as much as you can, because you earn it. You know, and there's no point. But anyway, so if he lives for another 30 years, him or his wife lives for another 30 years, they can draw down 23,500 extra from what they originally were, remember, of a year. That's 705,000. And if it was just prudently, they're only drawing down 3.5% a year. If it was growing up, say 4% a year, 4.5%, remember how much it is worth? It's 856 minus 214. It's 670,000 drawn down. You know, drawn down 3.5%, 4%. So that's 23,500 extra, because it's 33,000 a year. Was 10, will be 30. I'm now confusing everything here. His pension income from this strategy: 100,000 extra income comes in, 104,000 extra tax-free lump sum. At least 700,000 pension income come in, drawn down over 30 years, and there still could be fund balance after that. And here's another thing: if you remember the business, and we use, well, if people are thinking of selling the business, they will often use it. You know, the multiple can be related to. It should be really related to the revenues coming in for the individual, but it also can be related to profit and so forth, and so many other factors in relation to goodwill, and the systems are there, and how dependent business is on the management and the person who runs it. But in this scenario, we're just using a simple 5 times rule. In other words, 5 times the income that the business can produce. If I bought this business from him, and I used the system that he's using, how much income can I raise? Can I have for myself? In this case, we've increased the turnover by 150,000, from 300,000 to 450,000, the extra 150,000 in today's money terms. Of that, after expenses, it's 68,000 and 19,000, which comes to 87,000. Plus, whoever, if I was buying it, maybe I wouldn't actually need the accounting service. You know, may have my own accountant and so forth. Working on it. So the 3,000 a year, 68,000 plus 19 plus 3, 90,000 euro. In other words, 150,000 minus 60,000 is 90. So the business value, technically speaking, 5 times 90 is 450,000 increase.
So Peter, I'm just thinking is like thousands of the small businesses and big businesses in the country. And what I'm just learning from here is it's not a business, it's a strategy you design to increase or build your business. And I have seen personally my own family, the guys, they are in business from the last maybe 20, 30 years.
Yeah.
But they are in the same level. So they are not gone up, they don't go down, but they don't have any strategy.
Okay.
And
Yeah.
this is a normal in Ireland as well.
It is, yeah, it is. And that's why, as I say, I brought this in. Just give you actually an overview here of this. In fact, this is, oh, I'm not sharing the screen here, am I? No. New share. And I'm going here and share. Here we go.
Oh my God.
Okay, I know. Yeah, look at this. You see, this is normal. This is what I actually have. I like systems, because if we build systems, we can measure and we can be accountable and we can reduce the opportunity for mistakes. We can make sure things are covered. And in financial planning, there's a methodology that's used. And I designed then my own variation of this in order that I could actually speak to people to find out what they're about, to do a blueprint of their future, be able to show them, perhaps project their financial future as well. And from that, certain discussions have to take place in relation to their lifestyle and their ambitions. We have that on one hand, and then we take the financial side and the other side, and we bring them both, merge them both together by looking at their investments, their savings, their assets, their mortgages, their all financial instruments that they have available to them, including the state, as well. And we take into account their career, their position, their business values, and so forth, and what are available there that they can be used. For example, if we mentioned, for example, pension planning. If you're in a business and limited company, you can put in a significant greater amount of money in towards your pension planning pension than you can if you are self-employed with a personal pension. Okay, there's restrictions there on how much you can put in to your salary. So these type of business strategies, if you say, right, well, if you went to a limited company, we can actually create more wealth extraction for you. And then there's the aspect in relation to contingency. What if things go wrong? If I got sick, if I died, if my estate and so forth. So the components are worked on strategically into the planning. And then what we do is we put solutions in place and we review it. But as I said to you, many people then say, listen, I've been so busy, I haven't been able to get around to, and there's shortfalls. You saw examples where we're showing running out of money. And that's where I developed then the comprehensive wealth building program. And this takes into account what you're seeing here is this. But also, I showed you the ladder before of the, for the sales and marketing and the business growth, the wealth extraction, build them into the system as well. So that effectively we use this as the overviewer, as you say, for people who are in a business and they haven't gotten around to getting things, and we bring about action in the sales and marketing program, integrating that to create the revenue, so that then they find they're too busy and there's so many employees and need more, etc. So we're looking at opportunities for creating systemization, process building, for business opportunity development, and so on, and effectively creating then the picture of the money of the business value and the money that's there, utilizing that then in a business exit and succession program, allowing them to take the value of their business as well as whatever wealth and so forth is there. And we produce an exit program working with succession plan, first of all, with compensation focus, contingency focus, and then the actual confirmation focus. So whether or not you're working with a company where you have 3 or 4 co-directors, or whether you're self-employed, whether you the options that you have, once you have them clearly defined the way that you want to exit, that gives us our clarity. And then if that was to happen, how much money is going to be needed? We have that information from here, and how go about it. If something was to go wrong, illness and sickness and so forth, contingency, or if one of the directors was to die and so on, how are shares passed across and so forth. All of those items taken into account, plus the taxation element of course, and then putting it in form of shareholder agreements, pre-shareholders agreements, and contingency buy-sell options and agreements, etc. And the reason why it's important is this: it's an awful big step to set up a business, and people are terrified of doing it. That's why most people don't do it. And they're probably right, because if they have that level of fear, it can freeze them in action and create catastrophic results. But those who have stepped forward and put a business, start a business up, you can spend so much of your time running it that you're not able to realize how you can benefit more from it. Or you get to a certain stage where in year one, you go up to that level of turnover and things are going well because it's a great idea. You have contacts, you've made sales and so forth. And year two, you might go up to this level, and year three, and then it might dip, and then it might go up a little and dip. And the problem is you want to be up here, but you got so busy here in the circle here that you don't get a level. And that's where this type of program, this type of work came from, because I found that so many of my clients were going around in the circle, good years, bad years, good problems, big problems, bad problems, and not getting there. And I said, well, listen, how about you do this? How about you do that? Maybe you should do the other and so forth. And then I've formed a system. We take them from where they started here and they're going up around here, and then we take them up to this level and up to this level. And in fact, we bring the future forward. So like I've had clients who had 16, 18 years to retirement as far as their picture is concerned, and we were able to retire in 3 and 4 years because we put in strategies. And I think I showed you there the 1.3 million mathematical strategy, which is effectively use tax laws, prudent advice, and some strategies. And that in fact, that spurred that individual on. I mean, he was able to retire a lot earlier than that, and he still hasn't. Funny enough, he's doing extremely well. But that type, often it takes somebody to see, the expression, see the woods from the trees. And sometimes when you're caught in there, you just can't have you don't see the answer.
This is actually, I think, like the middle portion where you have the wealth, like what we're trying to achieve, what everyone is trying to achieve is we should have some wealth. If I have a product, how I can do the best strategy to market that one, and if I'm going to do some exit, how I can exit, what could be my exit plan, and how can I grow this business. So this type of the discussions are thought, or even I will say a bird eye view of your own ambitions is not happening with most of the businesses. Maybe they are not specialized in thought process. Maybe they never think about these things. They just like we call a word in our own language. Maybe other guys will understand as subtle thinking. So let's try. If it will happen, it will happen. If not, then it's okay. Worst is worst just a plan. Just
it's natural. It's natural.
Yeah.
It's natural because, I mean, at the end of the day, I mean, you can't be, we're not all experts in all things. I suppose this is another part of it too. And I know this, I know these even for myself, when you're self-employed, you think you know it all, realistically, you don't. But it's a kind of a different mentality because you're expected to have the answers. If your customer comes to you, you have to have the answer. If an employee comes to you, you have to have the answer. If a bank manager comes to you, you have to have the answer. You always have to have the answers. So if somebody comes along in, even in financial, planning, but you think you have the answers because, and it's not the case that you don't. All the answers even when I put this program in place for clients, I know, and I do tell them, you already have the answers. It's just that you're not taking the actions. And
that's the thing.
If I said to you, now if you did this, and this, you would forever be able to enjoy life with your family doing this, and this. And you kind of go, okay, now I can see a reason for doing all those horrible things I don't want to be doing, and it's so much of it. It's mentoring as well as planning, and it's giving people a reason. We all need reasons. We all need reasons to grow, to develop, to take a chance. And even though you know what's the right thing to do, if you don't see it, you say, I look at that another day. And the trouble is, you're starting out here, your turnover goes over here, you're going around and round in the circles and so forth, year after year and so on. And it's, and next year, but you're getting closer to retirement age, So what this is about, and, what I found the great thing about this work was that we're able to, it's like it's like a bucket of cold water being thrown on somebody, you know. You just kind of go, geez, is that the reality? You know, if I, oh my God, I didn't realize, I didn't have you know, where's the time, you know.
So Peter, I know I'm a little bit conscious about time as well.
Oh, geez.
So
Oh
if it is okay,
yeah.
should I just ask? I think we have Dr. Sajjad or maybe Sajjad, and if any of you wants to ask, discuss anything with Peter, so you can unmute yourself. Otherwise, I have a couple of questions for Peter. I think the guys that asked me on the other chat.
I'm on screen share, so if you want to take me off screen share somehow, I can't.
You can't stop.
Oh, stop! Oh, stop share. Okay, pardon. There it is. So it was most obvious. Sorry.
So, any of you would, Wasim Akhtar, Asif, Atif, Sajjad, if you want to ask anything, you can unmute yourself, or I can unmute you. So, Peter, let me just ask this. There's one question. Sure. One of the guy, he just asked that, what if you already have a long-term sickness benefit insurance available from your employer?
Yes.
Do you still just to buy one?
Okay, you need to know the conditions of that policy that you have with your employer, because some of them can be restricted over a certain period, and also, you know, relative to the contract that you have of employment. Some employers don't have to, you know, have to have continual employment if a person is ill. So yes, insofar as how much of your income can be protected, this is the broad way of looking at it. You're allowed to, by law, to protect up to 75% of your income. If your employer's plan will only give you, say, 30-40% of your income, 50% of your income, you are allowed to take, you know, you can take out other policies, another policy to fulfill the shortfall. It's like, for example, if you're in the public sector and you are paid a salary and you have, you're going to be entitled to a defined benefit pension of up to 50% of your earnings if you do the 40 years. By law, the government allows you to make pension provision for up to 66.66% of your pension. Okay, and that's where the discussion comes and the advice can come and so forth. And you know, if somebody says, well, if I retire on 50% of my pension, I won't have enough. Therefore, I'm allowed to make an ABC contribution, in other words, which is in other words your own personal pension, to build up to an additional 16% of your salary. Same applying in relation to your income protection. If you are you're allowed to take out a policy and make your premiums to pay up to 75% of your earnings minus whatever benefits you're getting. So if you're on 100,000 a year, which is just, I take 100 because it's an easy number, you can protect up 75,000 of your income. If your employer is only going to give you 50, say 50% of your income, you can take a policy to cover an additional 25%. Also, that's the income protection policy, and also you can take out protection additional above the 75% if you want to protect your pension premiums. Which is, you know, interesting enough. And again, in both cases, you're getting tax relief on the policy for income protection. So if you're protecting 25% of your income and you're paying, say, €200 a month, it's costing you, and you're a 40% taxpayer, it's costing you €120 a month. But it would mean that you're getting 25% of your salary should you be unable to work after what they call the deferred period. I think, you know.
Perfect.
Okay. Now, as I said, a lot of information, a lot of things we've covered here, you know, and I can understand, you know, if you know, people may well have questions and so on. And I would say that you have my details, you know, you can put them on the website and so on. And if people want to contact you, we're getting the answers. Want to contact me, we're getting the answers. I want to have a chat. I mean, if anyone wants, to speak, for an hour or whatever, that is, that's what I do. That's what I'm. As I said to you, when you suggested, maybe I come on, I said, like, if people want to talk to me, you say, much of it costs. It's not going to cost them anything to talk to me for an hour. They tell me their story. I tell them whether or not I can help them, point them in the right direction. And after that, if they want to do things, that's fine. But they're 100%.
No, I think definitely what I can see, they're like a multiple building blocks where we need to concentrate.
Mm-hmm.
We need to concentrate, especially I think within our own community, we have a loads of small businesses, lots of IT contractors, and they are doing the contributions. But what's the strategy? What's the exit plan? Where they just want to see themselves in 10 years when they want to retire, and I think sometimes due to no information, we don't make any decision. We don't decide things.
I'm going to show you something here very briefly, and I know I'm going to go off, but I'm going to, because that's actually what you said is so true. So many people feel, Jesus, I should have started it years ago, and I haven't started. It's not even worth my while. Okay.
Yeah.
Okay. What? Okay. I'm going to show you something here now. Where are we? Here we are. And okay. Can you see making finance make sense? Start at what you can afford. Okay, right. For those who are thinking that maybe it's not worth their while, or they should have started years ago and going to get depressed about it, don't. Because we're going to look at a very simple situation here. If somebody can only afford €100 a month going into a pension, we can use different strategies which are going to allow them to have a life and at the same time build up something that's worthwhile in the future. If you only started off with €100 a month, but you decide that you're going to put in 30% of any increase in your earnings also into the pension, along with the €100 a month. In year one, you have €1,200. If you're earning 50,000, and let's say, for example, I know, if you felt that your value to society or the business that you're in, that you can afford to give yourself an extra 10% increase a year, okay? And you decide, I'm not going to keep the whole 10%, I'm going to put 30% of that into the pension along with the 1,200. So in year two, you can put in 2,700. So remember, you only started off on €100 a month. In year three, you go then from 55,000, an extra 10%, which is 5,500, and you put in 30% of the increase, 1,650, into your pension, along with the 2,700 that you've already committed before, remember? And therefore, you've put in 4,350. Now, 55,000 plus 5,500 is 60,500. You're putting 4,350 into your pension, so you're still getting most of the increases that you got. Yeah. Also, on top of that, by the way, as a quick aside, you're 40% taxpayer. You're going to, if you're 40% taxpayer, if it's a single person, they're getting 40%, €1,600 of that, less tax a year to be paid.
Yeah.
Okay, so to start off €100 a month, and they give themselves, and they reckon they can get 10% additional earnings. 30% of that additional earnings is going to go toward pension cumulatively. In 10 years, 21,565 are going to your pension. Think of it, 21,000 a year going into your pension in 10 years' time. So you start now. So if somebody say 40 years of age and they haven't done anything yet, or even 50 years of age, not done anything yet, they know that using a simple strategy like this, putting 30% of the increase, because people we all have commitments. There's mortgage or rent, there's family, there's cost of childcare, there's cost of, cars and, everything. Of course, now it's the cost of living crisis that's coming in, and people are feeling, I haven't got the money. Make a start, €100 a month. Make a commitment that you're going to give a portion of your increase after that. And that, along with what you've originally put in, accumulates 21,565 going in per annum. Okay, the relative terms of the person's salary has gone from 107 to 117,000, 21 of that. Now we have to be mindful of the fact that there are limits if a personal pension of how much you can put in towards a pension, but even at that, it's not even reaching those limits at most ages, from anyone 30 years of age onwards. And if you're a company pension plan, of course, you can put in significantly more. For example, if you haven't done anything in your pension and you're 50 years of age, you can put up to 200% of your salary. The company can put in 200% of your salary into your pension that year when you're 50. And again, 50 year one, and year 52, 53, and 54. It's quite, because it allows you to put in a fund enough to earn 2/3 of.
Sorry, Peter. I just have a question.
Yeah.
If I'm a 40 years.
Yeah.
And if my annual salary is say 50,000.
Yeah.
So I can put 50,000 into my pension fund. That's what you're saying is percentage of.
Are you a sole trader or partner, or are you a limited company?
Sole trader.
You're a sole trader partner, so therefore, okay. And what age did you say? 40?
40, yeah.
Yeah, 40.
25%.
25%. Okay, yeah, 25%.
Okay.
Of your earnings. Now, if your earnings at that stage was say 100,000 a year, now the limit is it's up to 115,000. That's the current limit. In other words, if you're earning 200,000, you can only make pension contributions for tax relief up to 115,000 of earnings. The difference is if you're in a limited company, you're earning 200,000 and you have nothing in your pension. At 50 years of age, the company can technically put in 400,000 and there's no benefit in kind. And you can, now the maximum that your pension fund can be worked for tax purposes is 2 million. After that, it's not worthwhile, because whatever money to put in, they're going to be taxed back. In the three levels of taxation that happens after that means that you're going to lose 71% of it. So it's not even worth your while to go beyond the 2 million.
Peter, I think this is a very interesting one. So I'm a limited company. I'm at 40 years of age.
Okay.
And you see the percentage of salary. So I am earning 50,000.
Okay.
And the bottom executive pension plan. So what is 108%?
Okay, if you're on 50,000, it's 108% is at 40 years of age. It's it's 54,000. So the company can put in 54,000. You can draw down your own salary of 50,000 if you're drawing 50,000, and the company can put in 54,000 into your salary, into your pension fund that year.
Wow, I love this one. So I can build.
Of course you do. Sorry. Yeah.
Good.
Yeah. So what I'm saying is it's never too late. That's all I'm saying. And also don't despair, because a lot of people get, what's the point of what is it worth? And as you saw before, you can reduce and increase your contributions, you can stop them and so on, Now this strategy came from Benartzi and Thaler in the late 90s, early 20s, which they said, listen, people don't actually, it takes some time before they can get to the loose money that they can afford to put away. So they did out the maths of this. Now, in fairness, the actual maths of it, it's probably going back maybe, I don't know, many 100,000 years, millions of years, because it's, it's logical. But effectively, they call it safe work tomorrow. And it means that even though you put a small proportion of your salary in year one, as you go through, and if you do use a strategy, a higher proportion goes in. Now, the difference of this are quite actually astronomical. In fact, I'm going to show, where is it? Here we go. We share. Here we go. There's an example of the difference it makes to strategy. if somebody's, say, this is the person retirement age 60 years of age, to committing 30% of their salary increase to putting 5,000 a year into their fund pension with an index at another 3%, and if it was to grow at 6% a year, okay, the traditional 5,000 a year plus 5% will give them a fund of 400. Say after 15 years, we'll give them a fund of 133,000. But using this strategy, their fund will be worth 193,000. In other words, 60,000 euro better. If somebody was only, say, 30 years of age, and they did this for 31, 32 years, putting 5,000 a year plus 3% gives them 486,000 at the assumed 6% minus, charges, or 864,000. Now, 486 to 864,000. That's the difference the strategy makes. In fairness, they are putting more money in this way. But to be honest with you, because the effect of a compounding growth, and compound is, where's the compound? Let's show you the actual effect of compound. Here we go. We go to screen share again. Share. Look at this. This is maths. Okay, it's going to be a mathematical illustration using 10% for effect, but do not expect 10% returns per annum. And I'm saying that deliberately because I'm a financial planner, financial advisor, and I'm not going to be saying to people expect 10% returns. But I'm going to show you, who was it? Einstein, or they attribute to Einstein that he said compound interest is the eighth wonder of the world. I think he said something to say that. He says, those who understand it earn it, and those who don't understand it pay it.
You know what? This is someone just told me a couple of days ago.
Yeah.
Okay, I will.
It's so true. But watch this now. This is this just gets me. If you put 2,000 away, if you're 45 years of age, put 2,000 away, and it was to grow at say 10% a year. You put in 42,000 by the time you're 65. In other words, 21 payments made through 42,000. And it's worth 140,000 because of the compound. So you put 42,000 in, and it's now worth 140,000. That's compound. Okay, that's time. Okay. But if you were to start at 35 and go 5 years longer, in other words, put 52,000 in. Okay. Now here's where to stop. There's 52,000 is 386,000. Well, okay. But the third one is one that it just blows my mind, and all you got, you're all maths experts, and so anyone who's involved in IT and so on, you all know this stuff inside out, But this one really gets me. You put in 52,000 again, right? And you stop putting the money in at 50. You start at 25. You put in 52,000, and it's worth €1 million. So you put in 10,000 more than this person.
Yeah.
You just started earlier. There for 140,000.
And what's the assumption is 10% growth? Okay.
That's 10% growth. That's just pure math. So I'm saying it's never too late. That's the whole point. It's but also it also makes sense. Not to go about it's better to start early, naturally enough, of course, with compound.
Peter, I don't know. I'm interested to get this Excel sheet from you. So where I can put maybe a strategy for 5% or maybe 3%.
Yeah,
I think this is a very interesting one.
Oh yeah, absolutely. I mean, the thing about it is that the point we're making there though is this, that it's like a pebble coming down a snowball, it's coming down a roof, and it creates into a snowball. The longer the roof, the more snow is going to gather, So when people say, even if you're putting in a small amount from a young age, it can actually make a massive difference. But if you haven't put much in towards retirement at a later age, you might feel that it's not worth your while. Again, it can be worth your while because there's different strategies that can be used, and again, we're just talking about mathematical strategies here in so many ways, but there's also logical strategies in relation to your business and relative to your salary increase and proportions. So it's about getting those things together and being able to create the lifestyle that you want.
Okay.
Yeah,
Thank you very much, Peter.
you're very welcome.
This is very informative, and this is what I just want to just communicate with my community is. So where in IPIP, what we are trying to achieve is we are trying to help our community. We are trying to just educate the different aspects, whether it is you are going to hunt a job, whether you are going to just train yourself, whether you are going to start a new business. We really want to help, or whether you are wanting to build your financial strategies. So we have expertise. We get the expertise like a Peter. Peter, he has, like, what we are listening now is 30 years research, mature models, how we can improvise, how we can build our wealth, how we can build the strategies so we can sleep with confidence. We can wake up with confidence. We can say, yes, I am going to start my business by that day. Not randomly, I will say that, oh, next year I'm going to start my business. Let's plan if you're going to start business or start a business. If you want to build a wealth, how you're going to build a wealth. So again, I will say thank you very much, Peter, and
You're welcome.
and the guys. And I got a loads of thanks for yourself, Peter. The community is really is taking benefit. Definitely, I will upload this video to our channel and on our website. If in your permission, I will put your detail or maybe on our website. So if anyone wants
Sure.
to contact with you,
Oh yeah.
maybe we can route your phone number and maybe your email address or maybe even your website from our website to your website. So again, thanks for your time, much appreciated, and we will be in touch with you. Hope maybe if there's a more demand, so we might do another webinar on this one.
If any way I can help, I'd be delighted, you know. But thank you so much, for, you know, and I hope you all benefit. And wish you all a very happy Christmas, and hope to see you or you know, meet you soon. You know.
Yes. Thank you.
Thank you very much.
Thank you.